Should you be buying a mutual fund or an investment fund? This is a very controversial topic, and so let's get into what the book has to say. There are many types of mutual funds available, and there are many categories of mutual funds. There's closed-ended funds, open-ended funds, debt funds, bond funds, stock funds, balance fund, liquid funds, etc., etc. At least probably 50 different types of funds. And so another way of classifying these funds are the fund objective. What is it that it's trying to do? It's trying to beat the index or provide above average results compared to a specific sector. What is the composition? What is the sale method? Is there a load? Is there no load? And based on the type of fund you buy, you probably get capital gains, dividends, and you also get regular interest and dividends, except the fees. So mutual funds is has helped a lot of people get into the saving mode and given them a very convenient way of investing. They are highly a diversified set of investments, professionally managed, quite cheap compared to buying, selling individual stocks. In some case, you buy one mutual fund, you can get hundreds of underlying stocks, which if you had to do yourself, it would be too expensive. So mutual funds overall are a great strategy to diversify, even if it over time doesn't beat the index, because it's a very convenient way. And it's highly regulated, so over time you will see less and less issues come out. Beware of new mutual funds who show excellent results in the very beginning, because there are many ways potentially where you could boost up your performance numbers, like for example, fees being calculated as part of performance or not being calculated. Is the benchmark actually real, and whole host of ways. So this with this we now understand what a mutual fund is. It's one fund that you can choose to buy into, which gives you exposure to hundreds of stocks that the fund manager picks. And there are hundreds, probably thousands of mutual funds out there that you can pick. So let's look at their performance. It's a very controversial topic because based on the methodology, based on the time frame, based on the index that you compare with, different results will come out. Um, but the fact is that a mutual fund, if it gets too big, which there are a lot of mutual funds that are very big, that whatever they do in terms of buying and selling, their behavior impacts the market. And on an average, if you look at all the participants in the markets, and if there are big mutual funds, whatever they do represents the big part of the movement of the market. So market as a whole is the average of all of the activity combined. So now the question is, can some of these mutual funds beat the average result? So performance of whether they beat or not beat depends on many factors. Which mutual fund do you pick? When do you pick them? What are their fees? And remember the fact that history doesn't repeat. Most capable mutual fund managers that you pick today, a manager could change and some other fund hires them. So if you have to pick a fund that actually beats the market, then you need to answer all of these items in yellow. And there are many instances in starting from the late 90s, early 90s, where the Shenigans, the money managers of 69, the dot comers of 99, all of them in that short period of time, you could see extraordinary results for 5 years, 10 years. But if you have a larger horizon, maybe 10 years or 20 years, the percentage of those mutual funds beating the index actually goes down significantly. So based on the book, more than 20 years of investing, if you have that kind of a horizon, only 10 to 15% of these mutual funds would actually beat. Warren Buffett recently had many bets, many large sum bet with where he essentially said that anyone could pick any mutual fund and they would not be able to beat the index, and that's what happened. He won the bet. And so indexes actually have won over a long period of time. The other key insight is the small size necessary for outperformance when it comes to mutual fund, because if you have a large size, you don't have as many stocks to pick that will actually outperform. So you end up buying the same common stocks at a much higher price. And those mutual funds should have the courage to close the fund if they believe that they can't really perform and outperform or give better than average results. Thus, index funds, based on my entire reading of this chapter, have a huge advantage when it comes to costs, when it comes to simplicity, to beat most of these mutual funds over a long period of time. And this 15% is assuming that you stuck through those mutual funds when they actually were not beating the index. At the minimum, you need 3 years of sticking through before you make a decision to jump. So picking the right one is something that um, is our mind always wants to see patterns. So psychologists have shown that humans have an inborn tendency to believe that the long run can be predicted from even a short series of outcome. So if a fund beats the market, our intuition tells us to expect it to keep right on outperforming and continue beating the market, but that never usually happens. Data in this chapter shows that those funds that are high performance this year typically are underperformer the next year, or they're not at the first rank. And it's the biggest mistake I have made historically, is to pick the best performers without reading this chapter. So now you know not to pick them solely based on that. And if you need more data, read the chapter. The other piece is that although history doesn't repeat, the volatile stocks and mutual funds also continue to stay volatile. So this is where history tends to repeat a little bit more based on the book, which was also very interesting. Not only you don't want to pick those funds that have been high performers, but also not those ones that have a volatile return, because they'll continue staying volatile. So bad, consistent past performance is something that you should also avoid. A fund manager who's daring is an essential characteristic, because if you have a fund manager that just buys, if you look at their top 10 holdings, typically all mutual funds, you can find out like what are their top 10 holdings, and if they are similar percentages to the index fund, then they are at a very big disadvantage to actually beat the index, because the index operates at a very low cost, the churn rate is much lower, trading fees are lower, and so ensure that you look out for those fund managers that are daring, are contrarian at some points to actually get better results. And those fund managers, if they are shareholders in that fund, if they buy their own funds, that's a good plus. And make sure the fees are not too high, because it's very hard over the long period to beat the index, which is at 7 basis points or 4 basis points, when you are at 100 basis points in your fees. But even if mutual fund does not beat the market, I think for a lot of people, if they've not read this book, that mutual funds gives them some way to be, in an economical way, have a diversification to their portfolio. But reading this book, there's no reason why you should be buying a mutual fund unless you can do all of those things in yellow before. Probably a balanced fund equivalent of an index fund and a liquid fund is probably much cheaper long term for you. But it gives you freedom of time. Like if you buy a mutual fund, even if it does close to average, you get the freedom of time and flexibility to do things that you want, rather than picking stocks if that's not what you want to do. Again, trading expenses and researching companies is not cheap. So some of these funds, that's why they underperform over a long period of time. So best way they can do is average. And so if you want average results, then at very low cost, index funds probably the best way to go. So index funds win mutual funds on the long run by a big margin. So, but the biggest flaw of an index fund is they're boring. It's very hard to talk about index funds and their performance and how smart you were at picking them and how they are performing, outperforming the market, how big of a result they have, etc. Very boring. So if you can come over that psychological hurdle, you probably have a better chance of making and saving more money than investing in mutual fund. Hope you liked this video, and until the next one, thanks.